Welcome to our next installment of Building Perspectives. I'm Simon Keemer.
And I'm McCreary.
And with us today we have Christy Woodward. We're going to be talking about year-end closing the books and some tax matters. So Christy, introduce yourself.
Christy Woodward. I'm an associate director in the tax department, part of the firm's construction industry team. I have about 20 years of public accounting experience, probably more, in construction and other real estate, etc. And then I also have the benefit of I've spent probably 7 to 8 years out in industry in the construction world. So I have some pretty good experience, boots on the ground, dealing with, seeing what our clients deal with on a day-to-day basis.
Christy, thanks for being with us. Appreciate it. So as we think about year-end close, and you start thinking about our client base, but not just our client base, but your time in industry, what are some things that, some recommendations you would have for folks who are getting ready to go through that year-end process?
So the biggest piece, I think the most important for the construction industry is the WIP schedules, the completion schedules. And you need to do a thorough review of those. Go back through, tie them back into the books, make sure they're correct. Everything agrees, and you have done a sufficient analysis of it and feel very comfortable that it is reflective of what has happened in the business over the year. And then I think this...
Yeah, because really, I mean, that's the driving factor here. You know, I mean, you start thinking about it, and clients, those numbers have to be buttoned down. You know, the estimated cost to complete, it has to be buttoned down. The cost has to be buttoned down. The WIP schedule has to match the balance sheet. You know, those things have, because really that's what drives profit. That's what drives your margin.
Right.
And so, yeah, I think that's a great point.
And making sure those project managers are getting information in timely. I mean, it's going to come from the project managers what the contract value and estimated cost to complete are. So making sure you've got good communication processes to get that information flowing in to the accounting department on a timely basis.
Absolutely.
And that probably is the hardest part, is wrangling your project managers to get the information out of them. That's the hardest.
Yeah, absolutely.
From every client I've worked with.
Yep.
And then I think the second thing is, as you're going through, is just the balance sheet. If you can pin that balance sheet down and reconcile I'd reconcile every account on the balance sheet. I mean, start to finish, no stone unturned, because once you've got that balance sheet nailed down, you've got a lot of comfort that your income statement is also correct.
Yeah.
And I mean, I always would put together a work paper on every balance sheet account that kind of showed why it reconciled, why it was correct. And that also, if you're going through any sort of review or audit, that is helpful to your third-party auditors.
It saves time. I mean, it saves on time, for sure.
And to have some kind of closing checklist, maybe even a closing schedule, so that everybody knows what needs to be done, when it needs to be done by, and you can bring everybody together on the same page.
Right.
Okay, so we've got our books closed, and we know what our trial balance is. So you're both tax guys, so tell the auditor in the room, what do I need to be thinking about in terms of changes to taxes? What's new this year that we're going to see different?
Yeah, and I would a couple of things. I think number one, as I start thinking through where we are in the landscape of tax in the construction industry, number one, a lot of people take advantage of the R&D credit, and that really over the last 4 or 5 years, people have really started to take advantage of that. And I think it's great. I think it's a great benefit for clients. The issue we're coming up with now is, unless anything changes in the next little bit that turns the tide, yes, folks do get the R&D credit, but they have to amortize the expenses now over 5 years. So you have to pick that up, back up in income and get your deduction over 5 years instead of just getting the credit like we've done in the past, where we've been able to expense the credit. So, we've got that issue to deal with right now unless things change. We don't know if they'll change. They're liable to in the next 2 or 3 weeks. I mean, who knows? Who knows? It's kind of a lame duck session right now, so we may not get anything off the ground. The other item that's changed quite a bit over the last, with the Inflation Reduction Act, is the 179D deduction that's available. Used to that was a $1.80 a square foot, I believe is what it was, and it was available for folks who did the design work, the design build, the architecture, the engineering for municipalities, government buildings. They could get assigned that deduction and be able to take the deduction. Once the 179D study's done, it gets signed off by the municipality. And then the client gets the deduction. It's a phantom deduction. It's a great deal. You're not out any cash, but you get the deduction. Now they've extended that starting in 23 to expand to maybe some nonprofits, some hospitals, other entities where this is going to involve more people. They have put boundaries around it for being prevailing wage requirements and maybe some apprenticeship requirements. I don't want to go into the nuts and bolts of it here, but it's going to be vastly different moving forward. But they're also moving the square footage up to $5 a square foot, minimum of $1 a square foot. So there's some opportunities out there, I think, for the construction industry to take advantage of some of these options that are going to be coming out and starting to play a little bit more in the industry in the next year or so.
So if I've got municipal buildings or not-for-profit clients or hospital clients on my WIP schedule, I should be having some 179D discussions with my CPAs.
I think it's at least a stone you need to turn over. Just because, very similar to the 199 Cap A deduction that we have for flow-through entities right now, what we used to have with the 199 DPAD deduction years ago, where it's just a phantom deduction, you're not out any cash outlay, that's this 179D. So why not just talk about it? And if you've got any of those, and your clients may not qualify. You may have some that don't qualify. You may have some that do. And on the ones that do, you definitely need to have that conversation.
Okay, I've heard some changes to depreciation. Are they impacting 2022 or are they going forward, those changes?
So where we are with depreciation, unless Congress makes a change, and we haven't heard that there's anything on the horizon to make any changes, the 100% bonus depreciation that's been in play for several years now is in 2023 gets knocked back 80%. So now we're going from 100% down to 80% bonus depreciation. One of the things that brings back into play, which we've kind of not had to do, we have so much flexibility in the depreciation world right now, but it's going to bring what Section 179, where you can fully expense stuff, back into play, because where we're being able to write it off 100%, that's what Section 179 does. You've got some limitations over there, but it might be that we start doing Section 179 again and then save some other assets for the 80% to still get a pretty large bang for our buck.
Yeah, they've increased that 179 pot now to where,
right.
Heck, back when I started practicing, I don't want to date myself, but back when I started practicing, it was $25,000. 179 was $25,000 for no depreciation.
Correct.
Back in the 90s. And now it's well over $1 million for 179. So even though they're scaling back on this bonus depreciation piece, there's still the ability to have some write-offs and take advantage of some write-offs. So it's a good point.
So, yeah.
And then, we're obviously after December 31st right now. So let's say I did what I could do in December to tax plan and take the deductions that I could. Now I've closed all of my books. Let's say my income's a little higher than I thought it was going to be. Do I have any opportunities left as we sit here in January to take expenses or something to bring that taxable income down? What opportunities are there?
I think I look at the retirement planning world, and if you've got a profit sharing plan element inside of your 401k that maybe you want to fund, you got till the due date of the tax return plus extensions to do that in most cases and in most plans. That's probably an area where you could get a deduction and kind of defer the timing of that payment a little bit. That's probably one area.
The one thing on that is we can go ahead and accrue that. It has to be paid by the extended due date.
Correct.
So as long as it's paid even, if you're extended out to September, you just put it on the books and it just needs to be paid by September.
That's right. Yeah. So I think that, as I think about, okay, we've closed the year end, short of doing all the WIP review and everything that Christy was talking about, and making sure you got the right numbers in there, that's one of the areas I would be thinking about.
And beneficial for cash flow purposes. You take a current deduction for 2022 and not have to pay it out until late 2023, really.
Yeah, exactly. Well, Christy, thanks for your time. Appreciate having you on. And Simon, always good to see you.
Good to see you too, mate.
Thank you.
And thanks for tuning in to our current installment. We'll catch you next time.